There is a game being played right now that most people do not even realize they are sitting at the table for, and the people who understand the rules of that game are not panicking the way the public imagines panic is supposed to look. They are not screaming. They are not running to cash and swearing off risk forever. They are not liquidating everything and hiding in the dark until someone on television tells them the weather is safe again. They are doing something much more intelligent and much more dangerous. They are rotating quietly, deliberately, and with the kind of conviction that only comes from understanding that by the time the crowd notices the move, the easy part of the trade will already be over. That is how it always works. The crowd thinks opportunity begins when the headlines become obvious. Real opportunity usually begins before the headlines can be understood cleanly. The crowd reacts. Serious capital positions, that is the difference. And if you want to understand how generational wealth gets protected, preserved, and sometimes multiplied during dangerous transitions, you have to understand the difference between those two behaviors, because we are in one of those transitions. Now, not a cute little style rotation, not a minor sector reshuffle, a much deeper break in the relationship between debt, inflation, policy, rates, and what kinds of assets deserve to carry real money in the decade ahead. That is why I want to talk about Stanley Druckenmiller. Not because I think anyone should worship another investor. That would be lazy. Not because copying positions without understanding them is wise. That would be dangerous. But because when somebody with that level of macro awareness begins making a series of moves that all point in the same direction, the intelligent response is not just to notice the list. It is to ask why those positions make sense together. That is where the lesson lives. Now, a lot of people hear the name Druckenmiller and immediately think of one famous trade or one famous era that misses the point. The thing that made him extraordinary was not one moment. It was a repeatable ability to identify regime shifts before they were consensus and then size the trade with conviction when the framework aligned. That is a very different skill from stock picking in the narrow sense. He was never just asking what company will beat earnings next quarter. He was asking something much larger. What kind of world are we entering? What assets win in that world? And how do I get there before the crowd understands the map change that is the game? And I think that is exactly the game serious investors need to be playing right now. Because the old playbook worked in an old regime, 40 years of disinflation, falling rates, cheap money, globalization pushing costs lower, cap-weighted passive investing feeding the same winners over and over again, long duration rewarded, mega cap growth rewarded. The farther out the story, the more generous the market became. That world made a lot of people look smart. It also taught a lot of people exactly the wrong lesson. It taught them to assume that what worked in a falling rate, low friction, low inflation world would keep working simply because it had worked recently. Markets punish that kind of laziness eventually. And I think we are living in the period where that punishment becomes more and more visible. The new world looks different. Debt is larger. Deficits are more structural. Global supply chains are less trusted. Energy and security matter more than pure efficiency. Inflation does not disappear politely just because a central bank says it wants 2%. And politics in every major country is pointing toward more intervention, more spending, more strategic industrial policy, and more pressure on the old assumptions that held the disinflationary era together. That is the regime shift. Once you understand that, the rotation starts making sense. The first asset smart money is rotating toward is gold. And I want to be very direct about this because people hear gold and immediately sort themselves into two unserious camps. One camp thinks gold is for frightened old men and conspiracy theorists. The other camp thinks gold is some magical truth serum that automatically goes up whenever society becomes disappointing. Both camps are shallow. Gold is not automatically right. Gold is not automatically wrong. Gold is an asset whose usefulness depends on the monetary environment. And in this environment, the reasons gold is working are not the same tired reasons people repeat by habit. Druckenmiller has talked about an all roads lead to inflation framework. And I think that framing is exactly right because you do not need inflation to be exploding this second for gold to make sense. You only need to understand that the major policy responses available to governments are structurally biased toward inflation over the medium term. Deficit spending is inflationary. Tariffs are inflationary. Deglobalization is inflationary. Supply chain redundancy is inflationary. Industrial reshoring is inflationary. Security-first economics is inflationary. And when the menu of policy responses keeps forcing the system back toward inflationary solutions, then hard assets that cannot be printed become rational stores of value. That is the key. Gold is not working because people suddenly became nostalgic. It is working because the world is rediscovering that a reserve asset with no counterparty risk is more valuable when sovereign balance sheets look stretched, and the dominant currency has become more obviously political. This is where most retail investors still do not understand the depth of the move. Central banks are not buying gold as a trade. They are not buying it because they think they can flip it next quarter. They are buying it because they are reclassifying what kind of reserve asset they want to own in a world where exposure to any one sovereign currency has become a geopolitical vulnerability that matters more than almost anything else. Because when a hedge fund buys gold, that can reverse. When a momentum fund buys gold, that can reverse. When a central bank buys gold, a large amount of that supply goes into a vault and effectively leaves the floating market for a very long time. That is not speculative churn. That is structural demand, and structural demand changes the floor under the asset. The World Gold Council's full year 2025 data showed official sector buying still running at 863 tons. That was below the prior 3 years, yes, but still historically enormous. And Reuters kept emphasizing that central banks remained one of the key pillars behind gold's strength. That is not a side detail. That is the core of the story. The adults in the room are treating gold like A tier, one reserve asset again. Fay-site, Fay-turn, 771,981 search. 0 Fay-turn, 781 search. 3 Fay-turn, 771,981 search. 12 Fay now. People hear that and they say, fine. But isn't T-gold obvious already? That depends on what you mean by obvious. The market finally respecting gold more does not mean the reclassification is over. In many ways, it means the process is still underway, because if global reserve managers are still shifting behavior, if debt trajectories are still worsening, if real rates are still politically difficult to keep high enough for long enough, and if the monetary order is still under pressure, then gold's role is still being repriced. And that is before you even add the psychological dimension. Gold is one of the few assets that asks almost nothing of the system. It does not need earnings. It does not need a bond buyer. It does not need a politician to tell the truth. It does not need a regulator to behave consistently. It simply needs the world to continue discovering the cost of trusting paper too casually. That is why it matters. Now let us move to the second rotation, because this one surprises people. Financial Select Sector Spider Fund, broad bank exposure. A lot of people hear that and think it conflicts with the defensive framework. It does not. It only looks contradictory if you still think safe means goes down less in a panic. That is not how macro investors define safety, properly understood. Safety is about owning something whose reward potential is underappreciated while the downside is already well recognized. Financials fit that frame if your thesis is right. And the thesis here has multiple layers. The first layer is the yield curve. Banks do not operate on television narratives. Banks operate on spreads. What they pay for funding, what they earn on loans and assets, when the curve is flat or inverted, that hurts them. When the curve steepens, that can become a powerful earnings tailwind. This is one reason Druckenmiller's new XLF position mattered so much. It was not really a bank stock. Bet in the narrow sense. It was a macro expression of a steepening curve inflation persistence higher long rate framework whale wisdom. SQ4 2025. 13F summary shows XLF at about 6.7% of Duquesne's disclosed equity portfolio, making it a top holding rather than some tiny flyer. Fay-site Fay-turn 896,591 search. 1 Fay the second layer is regulatory. This is where the public loses interest because it sounds dry. That is exactly why it matters. Markets often pay a lot for stories and very little attention to plumbing, right up until the plumbing starts driving returns. The 2023 Basel Endgame framework threatened to force much more capital onto large banks. By 2026, that trajectory had softened materially. Reuters reported in March that the revised proposal would reduce big bank capital requirements by an estimated 4.8% relative to what banks were facing under the earlier push. That is not a tiny change. Less trapped capital means more flexibility for lending, more buybacks, more dividends, and higher returns on equity than the market had once feared. Fay-site Fay-turn 771,981 search. 5 Fay-turn 771,981 news. 30 Fay, and the third layer is valuation. That is where a lot of this becomes almost embarrassingly simple. After the regional bank scare and years of capital pressure, a big part of the financial sector was still unloved. Meanwhile, technology and AI-linked names had been bid into expectations that assumed years of near-perfect execution. Now, I love great technology businesses, but price matters. If one part of the market is adored, crowded, and expensive, and another part is hated, under-owned, and suddenly facing improving macro and regulatory winds, serious capital notices. That is not mysterious. That is the market still being a market. Now let us move to the third rotation, and this is where the public gets confused, because the asset does not look traditionally defensive at all. Natera genetic testing. Precision diagnostics. Why would a macro legend build what became roughly 12.8% of his disclosed U.S. equity portfolio in a company like that if the world is becoming more unstable? Because the public still confuses defensive with boring. I do not think that is the right way to define safety. Real safety in a long-term portfolio is often about asymmetry. You want something where the downside is visible enough that the market is still skeptical, but the upside comes from durable secular demand that macro noise cannot easily kill. That is what makes Natera so interesting. The company sits at the intersection of aging populations, cancer monitoring, prenatal screening, and cell-free DNA diagnostics. That is not cyclical fluff. That is healthcare demand with technological tailwinds. The world can have rate anxiety, political anxiety, trade anxiety, and market anxiety. And people will still need earlier cancer detection and better molecular diagnostics. That is why I take this kind of business seriously in a regime transition. It is not dependent on a soft landing fantasy to justify its future. Natera's latest numbers reinforce that story. Its Q1 2026 revenue rose to $696.6 million from $501.8 million a year earlier, up 38.8%. And the company processed more than 1 million tests in the quarter. Even more important, the growth is not coming from some one-time burst. It is coming from real volume oncology adoption and widening relevance. Phacyte Phaturn 896,591 search. 5 Phaturn 896,591 search. 16 Phay, and this is why Druckenmiller S concentration matters. A 13% position in a portfolio of this scale is not a curiosity. It is conviction. Whale Wisdom SQ4 2025 filing summary put Natera at 12.8% of the disclosed portfolio, his largest U.S. equity position. Phacyte Phaturn 896,591 search. 1 Phay now, the lazy observer says, but it still reports losses. I know. That is why the opportunity exists. Markets are good at pricing obvious profitability. They are often slower to price operational inflections where revenue is scaling. Margins are improving, volume is real, and the company is still investing aggressively enough that the accounting profile looks messier than the business trajectory really is. That is where you can still get paid. The point is not that Natera is safe in the old utility stock sense. The point is that the fundamental demand curve under the business is less sensitive to the macro regime than a lot of other growth stories, and the upside can still be very large if adoption keeps compounding. That is a different kind of safety. Now let us go to the fourth rotation, because this one is subtle enough that many people skip over it. The Invesco SP500 Equal Weight ETF RSP. On the surface it looks boring, an index fund, a basket. Why would someone of Druckenmiller-esque caliber deploy real capital into an equal weight ETF when he could just pick stocks? Because the choice of index is itself a macro statement. A cap-weighted SP500 is not the same bet as an equal weight SP500. And if you do not understand that difference, you do not understand where we are in the market cycle. In the cap-weighted version, the biggest companies dominate. The top 10 names can drive a third or so of your exposure. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and the rest of the usual royalty do an extraordinary amount of the heavy lifting. That was wonderful when concentration kept working. But concentration can become a danger when the trade becomes too obvious, because once everybody is already in the same magnificent winners, the marginal buyer gets weaker. And when the marginal buyer gets weaker, expectations become more fragile. One earnings miss, one macro shock, one change in capital rotation. That is all it takes for a crowded, top-heavy market to discover that breath was missing the whole time. That is why equal weight matters. It says, I still want us equities, but I do not want all my fate tied to the same crowded giants everybody already owns. It says, there are hundreds of other American companies with real earnings power, real operating businesses, and far less euphoric valuation risk. And that is exactly the point. The equal weight bet is not bearish. It is a breadth bet. It is a bet that late cycle capital starts moving away from the most crowded perfection stories and toward the broader economy. That may be manufacturers, healthcare, industrial names, retailers, financials, energy-adjacent firms, regional winners, all the businesses that still matter enormously, while the market spent years pretending only 7 companies truly existed. And Druckenmiller, SQ4 2025 filing made that view visible. His RSP position was about 5% of the disclosed portfolio, large enough to matter, small enough to be elegant, and completely coherent with the broader regime thesis. Phasite Fay turn 896,591 search, 1 Fay turn 896,591 search, 15 Fay. Now let us get to the 5th asset because this is the one that creates the most argument. Bitcoin, the public still cannot talk about Bitcoin like adults. People either talk about it like it is salvation or like it is clown money. Neither framework is serious enough. I think the right way to understand Bitcoin in this context is as a second-order hedge inside the same broad debasement and hard asset framework that makes gold attractive. But it is not the same thing as gold. That distinction matters. Gold is the first responder in a confidence scare. Gold is the asset central banks themselves will accumulate. Gold tends to behave better in immediate panic. Bitcoin does not do that reliably. Bitcoin can get crushed in a fast liquidation. It did exactly that during various risk-off episodes, including the October 2025 liquidation wave tied to tariff and policy fears. That matters because you must not confuse a high beta monetary hedge with a crisis stability asset. They are different jobs. What Bitcoin does offer is digitally enforced scarcity, outside direct sovereign control, and after the approval of spot Bitcoin ETFs in January 2024, that thesis became institutionalized in a way it had not been before. Reuters described the approvals as a watershed moment that dramatically expanded the investor base that could access Bitcoin through traditional structures. Phasite Fay turn 771,981 search, 13 Fay turn 771,981 search, 7 Fay. That matters. Because when an asset crosses the line from outsider speculation into institutional accessibility, its role in portfolios changes, not overnight, not perfectly, but structurally. Now, pension funds, Rhode Island as macro funds, platforms, and other pools of professional capital have a cleaner path to owning exposure. That does not guarantee price appreciation. It does change the adoption universe. And this is where I think the gold and Bitcoin pairing becomes intellectually interesting. They are not redundant. They are different expressions of a similar distrust. Gold is the low drama reserve hedge. Bitcoin is the more volatile, higher beta, harder edged expression of the same long-term suspicion toward currency debasement and monetary excess. Gold helps first in the panic. Bitcoin often pays more in the reflation and recovery phase if the debasement thesis keeps hardening. That is why smart money can own both without being confused. Now let me step back because none of these assets are random. That is the important thing. Gold, financials, Nadera, equal weight, U.S. equities, Bitcoin, at first glance, those may look like unrelated pieces. They are not. They are coherent expressions of one larger framework. And that framework is the thing I want you to remember when this video is over. We are living through a regime change. That is the idea beneath everything. The old world was friendly to long duration assets, mega cap concentration, disinflation, globalization, cheap money, and passive cap weight complacency. The new world looks friendlier to hard assets, curve-sensitive financials, secular businesses with real volume and less macro dependency, broader equity participation beyond the top heavy winners, and alternative stores of value outside pure sovereign discretion. That is the shift. And if you do not update your mental model, you can own the wrong things for years while telling yourself you are being patient. That is not patience. That is inertia wearing the costume of wisdom. Now, I want to say something important here. This does not mean the old winners all collapse tomorrow. That is not how regime change usually works. It is messier than that. Some legacy winners keep working, some crowded stories keep levitating longer than seems rational, some transitions take years. That is precisely why serious investors rotate gradually rather than theatrically. They do not wait for some grand bell to ring. They move while the old world still looks mostly intact. That is what rotation is, not panic preparation. And the cost of failing to rotate is not only underperformance, sometimes it is the permanent loss of purchasing power that came from holding assets built for a world that no longer exists. That is the real danger. Now let me make this even more practical. When I look at these 5 rotations, I do not see a shopping list. I see a way of thinking. Gold says the reserve structure is changing. Financials say the curve, the policy regime, and regulation may be changing in ways the market has not fully priced. Nattara says true secular growth, with improving economics, matters more than macro noise, if the demand curve is durable enough. Equal weight says breadth is likely to matter more than top-heavy concentration, if capital starts searching beyond the obvious crowding. Bitcoin says digital scarcity has crossed into institutional relevance, even if it remains more violent and less stable than the old hard reserve hedge. That is the lesson framework first, positions second, because if you understand the framework, you do not need to wait for a billionaire filing every quarter to tell you what the world is doing. You can start reading the world yourself. That is where the real wealth skill lies, not in copying, in understanding. Now, let me leave you with the most important question you can ask yourself right now. Was your portfolio built for the world we are entering, or for the world we are leaving? Those are 2 different portfolios. One was built for disinflation, cheap capital, concentration, and smooth global efficiency. The other must be built for stickier inflation, fiscal strain, strategic redundancy, policy conflict, and a broader search for stores of value and under-owned earnings streams. If your portfolio still assumes 2015 is the future, the next 5 to 10 years may feel a lot more painful than you expect. And that is why this matters. Not because I want you to blindly buy gold tomorrow morning. Not because I want you to blindly buy XLF or RSP or Bitcoin or a diagnostic stock just because a famous macro investor did. I want you to understand the nature of the shift, because the people who preserve and compound wealth across multiple decades are almost never the people with the best slogans. They are the people with the best regime awareness. They know when the map changed. They know when old habits became dangerous. They know when the crowd is still speaking an outdated language. That is the edge, not prediction in the cartoon sense, regime recognition. That is what Druckenmiller has done better than almost anyone. And if you can learn anything from that, let it be this. The goal is not to react faster once the crowd understands the trade. The goal is to understand the trade before the crowd realizes it has already begun. That is how wealth is protected. That is how capital survives the storm. And sometimes that is how it grows while everyone else is still trying to figure out why the weather changed.